Welcome to the Real Estate of Things podcast. I'm your host, Dalton Elliott. I'm joined today by Sam Wilson of Bricken Investment Group, a firm based in Memphis, Tennessee. Sam is an active investor in everything under the sun: self-storage, parking, multifamily complexes, RV parks, single-family homes, and as if he didn't have enough time in the day, also the host of a daily podcast, How to Scale Commercial Real Estate. Sam, thank you so much for carving out some time to join.
Hey, man, the pleasure's all mine. Thanks for having me on, Dalton.
For sure. So when I was learning a little bit about you, real estate is what I live and breathe on my side of the fence. But before we dive into that, I have to ask you about parking, right?
Sure.
What does an investment in that space look like? How do you value the asset? What are the financing options? I am incredibly curious because I know absolutely nothing about it.
Yeah, most people don't, to be honest with you. It's a niche asset class. I mean, it's something pre-pandemic that was it was becoming a very challenging asset class to buy on any numbers that made sense. You could buy parking lots in central business districts from, of course, everybody's going to say this, from 2010 to 2017, 18. Where the parking as a parking investment made a lot of sense. Because you could buy it, you'd have operators that operate your lots. Of course, they're valued based upon net operating income, and that's what you bought. You're buying a business with land attached to it. But that model really was starting to go out the window as these, as developers and development started happening back in these in major urban centers. So parking lots started getting sold on square foot basis. It became very, very challenging to find a parking lot that could be underwritten and purchased at a price that made sense. Even as a covered land play, it became challenging. So, stuff was selling that would, the prices wouldn't even cover taxes. So it became a very difficult. And then the pandemic just really was the stab in the heart for parking investments. It's coming back. I mean, there's still great opportunity. Parking garages, I think, are still, in the right places. Man, I'd love to own more parking garages, but for us, I'll just give you the full color of the, what we did. We really just bowed out. March 2020 came. We were fighting like cats and dogs to get a deal across the finish line. It was like, what, this is too hard. So just took a real step back from that. We may dive into that again. How is it valued? I think I answered that, but maybe I didn't. Net operating income, just like everything else. If it's making $100,000 a year and you're buying it on a 10 cap, we're just going to use easy numbers because I'm not, using a calculator. It'd be, worth $1 million. And that's how you paid for it, or that's what you would pay for it. But it's a very simple business, clean. It was very, very hands off. Once the asset was purchased, financing, you'd have to have the right banks that understood what you were doing. A lot of times you'd have guaranteed leases where you would just know exactly exactly to the penny what you were going to get paid that year. You'd basically sub it out to an operator that'd say, all right, I'm going to pay you X number of dollars for the rights to operate this lot. You go to your bank and say, hey guys, I've got a lease for 3 to 5 years. This is what it is. They're underwriting the lease that you've been given from that operator. And we'd always work with national operators because those were the big boys that, they were publicly traded and, had the balance sheet to back up the lease they were guaranteeing. So that made financing a lot simpler.
Sure. What's normal leverage?
80%. I mean, again,
oh, really?
Yeah. If you've got and we had the right relationships to get that, but yeah, I mean, it just made sense. Again, it was kind of like buying the better cap rates on the buy side, but it was kind of like buying triple net leases or things like that. Actually, a lot of them were triple net leases. So it was a very easy, once acquired, an easy hands-off business to own or hands-off asset to own. But again, we've stepped back from that. May go back into it here shortly, but we'll just kind of see how things shake out. It's also something where, we've kind of switched gears and really dived into some other asset classes. So, we could always get back in if we wanted to, but right now it's kind of, on the back burner.
For sure. The real estate market on fire, right? We're on an absolute tear right now. So what are you focusing on? What asset classes have your attention? And to toss one more question in, how have you had to change your real estate strategy, pre-pandemic to today?
Yeah, that's a good question. Focused on self-storage and multifamily, which I mean, whoop-de-doo, everybody's focused on that, right?
Yeah.
Like, but changing strategy on that. I mean, the thing is that there's still opportunity out there. It's hard to find. Everything's tough to find. So it's not just limited to parking assets that make sense. It's tough in all asset classes, but there are still deals out there. So focused on those two primarily. On the I forget what your next question was, so I'm just going to keep talking, and you can tell me to shut up whenever whenever I've gone off script here. But those are the two that we're focused on. The launch of the podcast, rebranding. It has been a big part of that. I had to completely rebrand. We were parking your investments before, which was just kind of I'm just play on parking because that's all we were doing. So
Right.
complete rebranding, and just shifting gears. But that's part of business is just being flexible and seeing when the winds shift. Go, okay, all right, change gears, retool, pack everything up. We're gonna sit here and think about this for a minute, and then we're gonna change directions. And that's exactly what we did.
Yeah. So multifamily is the focus now. I assume you did not get your start in real estate in multifamily. Is that right? Were you on the SFR side first?
I was single family for far too long. Never quite figured it out, which is, I did 60 some odd flips, owned a bunch of rental property, and so I bought at auctions. We did everything, man. I mean, it was iteration after iteration in the single family side. In 2018, bowed out of that. I said, look, so 2013 and 2018 was all single family. And for me, it was not scalable in a capacity in which I liked it to be scalable. And again, it goes back to everything from the people you're buying from to it's also the easiest point of entry for really anybody getting into real estate. It's where 95%, I think I'm just making statistics up, which they're all made up on the spot anyway, are people. That's where they start, right? It's like, oh, single family. I'll just that's an easy one. I can buy a house. Most people can buy a house. And so I realized that I was competing with the least skilled people in the industry, and that's frustrating. Where you're like, all right, you're an idiot. You paid $100,000 too much for this house because it's your first purchase. I can't compete with that. And so just duking it out. We're kind of seeing that in the multifamily side of things right now too, where big money's just chasing. They're just chasing any yield. It doesn't matter if it's 10 basis points above zero. They're chasing yield in any capacity because everybody else is getting negative yield overseas. So why not dump it in the U.S. market where they can get any sort of positive yield? So again, we're duking it out on that front too. It's just more zeros attached to it. But I digress. In 2018, I had enough, and I said, man, I'm going to switch gears into another asset class, and that's when I moved into parking, and then in March of 2020, shifted gears from parking into multifamily and self storage.
Yeah. So the multifamily side, whenever you went from SFR to multifamily, what were the biggest, most notable differences when you're valuing the asset? Did anything pop up surprising that, you're like, I'm a real estate investor. I've been invested in real estate for years, going to do multifamily. It's the same thing. It's real estate. What surprises, lessons learned? What was in, call it that first round of deals you did?
Yeah, and I think that the notable thing there is that it's almost easier to get financing done, which is crazy. And I've heard that 1,000 times, like the same amount of paperwork, just bigger dollars, if not easier, because you're underwriting an income producing asset as opposed to underwriting a single family home, what it could be, what it might be, and then monkeying around. Just the hoops you have to jump through, I think, is probably one of the most notable things where you're dealing with, again, professional industry players on the financing side that you just go, okay, this is a lot easier. I mean, yeah, you still got a lot of stuff to do, and there's still, there's still hangups in it, but it's just, I don't know, when anytime you can institutionalize and I'll make up a word here, but professionalize things, I think it becomes easier just from a feasibility side of things.
Yeah. Yeah, it's definitely a different animal. I got in on the multifamily financing side, and it's probably 3 or 4 years ago. And I thought, how much different can it be than, the SFR side? And from a dollars and cents standpoint, yeah, it's just bigger money, but it is a much more standardized process nationwide, the multifamily side. And I think that's because the large institutional money has just been playing around in that space for a longer period of time. And you mentioned kind of the big players, bigger institutions. Want to touch on that a little bit. So conferences are back live. We're traveling. We're sitting in rooms listening to folks talk, prognosticate. And one topic that keeps coming up, the last couple ones I went to, one was a multifamily specific conference. But one topic is kind of the David and Goliath fight between, call it run-of-the-mill investors and institutions, right? Should we as real estate investors be scared of these institutions who are swooping up, 500,000 property portfolios left and right? Shifting gears really to the SFR side of the fence for talk. Is that something that you're seeing? You're in Memphis. You're in a super hot market. I know you invest outside of Memphis, and we're going to pick your brain about some secondary and tertiary markets where I think the massive opportunities are, or the findable opportunities are at this time. But what's your take on that battle, if we can call it that?
On the single family side?
Yeah, single family, kind of mom and pop investors versus institutional investors.
And that's one of the things we saw here in Memphis. It's a great, well known for its exceptional cash flow. You can buy real estate here and that's going away, obviously, with the prices of everything driving up, and part of the institutional money coming in has really changed that. But even at auctions, which is where we really spent the bulk of our time, was at foreclosure auctions. And it became apparent that you would have these REITs or these hedge funds that would come in, and we'd be at an auction and they may have $5 million in their pocket to spend, right? And they may be paying 95 cents on the dollar or 98 cents on the dollar for a property they've never seen the inside of. I couldn't compete with that. Like, I'm a small fish. We had a few $100,000 plus some hard money to spend. It's like, all right, so I can buy one or two houses at a time. I can't duke it out with you on that front. The risk is way too high. So, I don't know if I'm answering your question or not, but that's one of the reasons we stepped out. So yeah, it squeezes people out, but it also that's on the buy side, but also you got to look at it the other way too. On the sell side, you can get paid. So right. It just depends on which side of the fence you're sitting on that you go, gosh, this sucks, or man, this is beautiful, because it's driving prices up for everything. And so I've unloaded some stuff this year on the single family side, just trying to get rid of some legacy. I'm all about commercial, and that's where I want to be and where I want my focus to be. So I've been divesting of assets, and it's like, asking price plus, no contingencies, no inspections. Like, this is madness. Yeah. For rental property that you go, there's hardly cash flows. Sure, sign the contract, go.
We have money, we want property. It's a simple equation here.
Simple equation. There's a buyer, I'm a seller. Thank you. Have a good day. I'll take your check.
I know. No shortage of folks, especially during the pandemic, talking with who, have aggregated even as little as 50 or 100 properties in a portfolio that are getting attention from institutional groups. Like, sure, we'll take a look at it. We'll see if it fits our box. And it's a simple yes-no formula, right? Yes, this fits our box. No, it doesn't. Right. If yes, then money goes out the door to you. So there's a double-edged sword, as with everything, right? And like you said, depends on which side of the transaction you're on, which market, how you're competing. It's not as simple as I think some people would like, or some people feel the answer is.
Right, for sure. Yeah, there's definitely pros and cons to it.
Yeah. So let's talk a little bit about, we have primary, secondary, and tertiary markets, right? That's how markets are broken up.
Sure.
Primary markets, absolutely blazing fire. Austin is my favorite one to pick on, isn't it, for everyone right now? But like May of last year to May of this year, upwards of 40% year over year appreciation, which
Holy
is just
smokes.
absolute craziness. So, you look at there, probably not going to find a lot of good deals and steals in the Austin market or other primary markets. So looking at secondary and tertiary markets, I know you just closed on a deal. I'm in Greenville, South Carolina. You're in Memphis, not too far away. You closed on a multifamily apartment complex in Columbia, South Carolina, which is an hour and a half east of me. Talk to me a little bit about why you're getting into that market. What's the draw for you for secondary and tertiary markets? And do you have to change your approach when you're investing in, a larger market like Memphis compared to a smaller market like Columbia?
Yeah, that's a great question. Yes is the answer. I mean, you can get burned if you go back to 2008. The number of investors there's what they call that recency bias, where people just forget that the crap actually hit the fan in practically everything. And a lot of multifamily investors lost their shirt. And why did they lose their shirt? I think, again, I'm just kind of, I don't have empirical evidence to substantiate these claims, but it's just kind of from observation. You go, well, why'd they lose their shirt? Well, because they went to, markets outside of major markets. They went to small towns, almost, say 30 or 45 minutes from maybe the downtown, right? A little too far out for most people. Maybe those markets were based upon a certain industry where, you had only one or two major players that were supporting the people living there. I mean, I'm talking a number of people who are they said they had parking lots full of moving trucks. Okay, half the tenants are moving out in a week, and you've got a 200 unit property. I mean, these are real life stories, and I just sat there with my jaw on the desk going, with the management company literally getting a call, and they were crying, going, my gosh, what do we do? They're not even hey, we're breaking the lease. They're just packing up and leaving. It's gone. The town dried up. So I think it's one of the mistakes that people made is they got too far out. But that does not mean that you can't go to secondary markets or tertiary markets. You just have to really know the metrics that go into those, and see how they're valued. Why is Columbia? And again, I'm not all, I can give you a dozen reasons why I love Columbia. But there's a lot of good anchor stuff going on in Columbia. So I don't view Columbia as that one employer town, or that one, it might be one, somewhere else, maybe one employer town 30 or 45 minutes from downtown, but it's just too far out. So Columbia is not that. So looking in the Columbias, the Greenvilles, places like that have, incredible metrics to them, and still, promise the potential for return. So I think looking at those, looking at the job growth, looking at, developments, looking at what's going on at the city county level, what are those, just looking at all those things and saying, hey, look, this paints a good picture. And also the other thing you can do is go smaller, right? If you don't want to compete with the big boys buying, 300 plus class A, maybe you can go class B minus, and maybe it's 100 units, or maybe it's 75 units. Maybe you go underneath that ceiling of where everybody else is flying. You go, okay, we're gonna stay low, and you can pick up stuff that way that still makes sense. So there's things you can do, but again, I'm notorious for wandering all over the place here, Dalton. So I have no idea actually what your question was.
No, you nailed it. Just going through the really secondary and tertiary market analysis approach.
Yeah, and looking at stuff you get too far out there. I don't know anything about Wichita, Kansas, right? I don't know anything about it, but that's one that comes to mind where I just go, Wichita. That seems like a place that could dry up in a hot second. I could be dead wrong. I have no idea. I've never so much as done even a population growth study on Wichita. Kansas City is another tertiary market that people are interested in, but what are the dynamics there? I don't know. I'd be more betting on Kansas City than Wichita. So those are things also I look at and I just go, okay, keeping your criteria refined, I think is super important. So, and again, I don't want to rehash everything I just said, but those are some of their thoughts surrounding that.
Yeah, really, really just seems like it boils down to risk reward. Your primary markets are always going to be your most stable because they're the most population dense with the most employers and the most action going on. And then the further you get away from those major metros, the risk reward just increases, right? You're not going to have to compete and pay as high of a price, but there's reason for that.
Right.
And sure, we're seeing this in the Greenville area. It's just a growth outward. Same thing with Atlanta, just a clean growth outward. But that's not the case everywhere. So to presume that, hey, this place is 30 minutes outside of the action, but 5 years from now, surely it will have expanded. Maybe not. That's where you talked about, population growth, population density, and really analyzing what do the growth patterns look like? What are the draws? Are there new employers coming into the town that are going to throttle that up? That's definitely something on the multifamily side that, we were talking about the differences between SFR and multifamily. SFR versus multi. On the multi side, so much more of that comes into play whenever you're looking at a project, right? Like what does the employer activity look like? Is it if it's near a military base, that's a plus. If it's near, if it's in a college town, or like all different types of factors come into play, where on the SFR side, there's a little more simplicity. What's the value of this house?
Right.
On the open market.
Right.
Less at play there.
100%. It's interesting. I was talking to a guy yesterday he's a big data analyst. Like, we talk data on stuff that you can't even. I was just like, dude, I'm drinking from a fire hose. But one of the things he was talking about was he called it his affordability deviations, where he would take 1,000 properties in a market, and then he would take the average incomes and he would compare that to the markets with the greatest. He would compare the incomes to the rent price or the sales price of homes, right? And he'd call it his affordability deviation. He called it one of his downside predictors, right? And so then he would say, okay, so we've got this data, and then he would go back and compare it to 2007, and he would say the greater the spread between the price to rents, or excuse me, the income to rents, or the greater the spread from income to housing prices, the sharper the correction, right? And so it was he picked out a bunch of markets, and he would say, all right, so here's the ones that really took it on the chin. And then he would say, but look, there's also some markets in this same time frame that were undervalued, where the income growth relative to rent price or income growth relative to the average home price was, much smaller, and or, the income was increasing at a rate greater than the price of the properties, which was just a really fascinating. I mean, he did over thousands and thousands of properties. And I was like, that's a really unique way of looking at. So, doing things like that against a Charlotte market, right? And say, okay, what's that look like? Is Charlotte overpriced, or is it just right in line? I don't know. It's one of those things.
I think that is an incredibly important piece of advice that gets lost.
Mm-hmm.
I think that too often, investors and folks in the real estate industry as a whole tend to get caught up in trying to boil down the entire United States real estate market to a couple of headlines. It's doing great, it's booming, or it's going down, it's terrible. Just because it's on a downslope doesn't mean that it's not investable, right? They're going to be, know your market.
Right.
That's the big piece of advice there, that regardless of what's going on, and if I'm in Greenville, South Carolina, and New York and San Francisco and Austin are, going up or down or whichever way, that, it may happen that Greenville is having similar effects, or it may be the complete opposite. So even whenever headlines may read one way or the other, if you know a market and you feel good about it or bad about it, you got to do your own homework. You cannot just feel like, if I buy it, they will come. If I buy it, it will continue producing.
Right.
You got to have a little bit of eyesight out in front of your skis.
Yep.
Yeah, for sure, for sure.
Yeah, that's well said.
Good. Yeah. So one more kind of pointed question, right? You have massive experience across all these different asset classes. From and answer this however you want, from simplicity's sake, from just dollars and cents sake. What's your favorite and what's your least favorite asset class?
That's a good question. Favorite asset class. My favorite one is the one that makes money, right? I don't really care if it. I mean, we could be selling dog kennels, and if it's making money, man, like great. Yeah, I don't know. I'm an opportunist. So, if there's opportunity, I want to participate in it. Yeah, that's unfortunately the wrong answer, but I like multifamily. I think it's fun. I think it's unique in its ability. It's to take the cash flow and leverage that into an equity gain. I think that's amazing where you can raise rents. If you can produce $25 a unit across X number of units, and suddenly you've just created several $100,000 in equity, like that's brilliant. It's harder to do in self-storage, but not impossible. There's still that there. You're just not going to get quite, I don't think, the equity multiple that maybe you do in multifamily. So, and those wins can change too. So that's something to keep in mind. But I mean, those two are great. One asset class that we are actively pursuing is boat and RV storage. I don't know if anybody's paid attention to that, but boat and RV deliveries are up like 30% year over year in 2020 to 2019, and they've done it over again in 2021. I mean, that's madness. That is madness. Like 30% growth in new deliveries, which is it's just stemming from two things. One, incredible amounts of money being flushed into the system, and then secondly, obviously the lack of travel outside of the United States and more restricted travel. Has said, it's forced people to go, okay, we're going to kind of retool the way the family vacations. So with that, I mean, where do these people have to store this stuff, right? They're gonna have to find your neighborhood. Your HOAs aren't going to allow you to park that 35-foot RV in that brand new boat in your driveway. So I think that's an asset class that is only going to, or a niche inside of the storage asset class that's only going to get stronger. I mean, you go out to these places in Colorado. I've toured more storage facilities like this. Not even like buildings, just open lots, 6-foot fences, controlled gating. And I mean, and there's marked out spaces, but that's it. I mean, just stacked hundreds deep, and it's like, my gosh. This is and they don't use them that often. What do they use them? I own an RV, and luckily I live in a place where I can park it in my own driveway. It might get driven once a month, maybe once every 6 weeks. So you gotta. I mean, I live in an older neighborhood where we don't have to pay HOA fees, but
So when I was in the very end of high school and college, summers I would spend at a campground. I grew up in Myrtle's Inlet, just south of Myrtle Beach area, and did landscaping at a campground. And one of the most constant, know it's going to happen drives for revenue was storage.
Right.
Especially because some people would make their last trip of the year, bring the kids down for Labor Day, right? Just before school starts, last trip, leave the RV or camper, and then take the car back home. And then the first trip, when everything warmed back up, was back down there to the same campground. Pick your camper up. They would winterize it, charge you a fee. They would de-winterize it, charge you a fee. And it's just this gated open space with RVs and trailers like backed in 6 inches apart from each other. We had 2 guys at the campground, and that was their job. They would move those things in and out when people were checking in, and the whole summer, that's all they did, 8 hours a day, 40 hours a week. So no surprise, my wife and I have chatted about getting an Airstream early on in the pandemic, and it was not early enough that we had the conversation because we were in Dallas visiting my sister, and we swung by a massive Airstream dealer out there, and the place looked like it had been robbed. They had one one tiny Airstream and one big demo Airstream. And they're like, yeah, get in line north of a year for delivery times. And we're like, well, guess this just isn't meant to be. Pandemic might be over by then. But
Right.
all that said, something that pre-pandemic you could get easily 15, 20, maybe 25% off. Now it's full boat and get in line, and then we'll get it to you when we get it to you. So the storage piece sounds pretty enticing.
Yeah, you're 100% correct. 100% correct. And Lord help us if there's a downturn, because that's when your opportunity to buy all these is going to come. You take all that knowledge you have in in lease options, in buying things, subject to leaving debt in place, things like that. I mean, essentially, buying out the note or leaving the note in place. I mean, I think you're going to have your opportunity. There's another prediction, a wild prediction, but I think here when we see a correction, you're going to have loads of opportunity to buy as many of these RVs and things that you want. Where people 2 years later are like, well, crap, I can't afford that anymore. What am I going to do?
Yeah.
And we got 100% financing on it. I need out. So I don't know.
Yeah. Yeah, I think we came to the same conclusion. Like this, certainly, that type of vacationing may have a normalized uptick because of it, but it's not going to be anywhere near the uptick in the actual units themselves. Right. So yeah, I think wait on the sidelines a year or two, then maybe pick one up at a sweet discount.
Yeah,
it seems to be the play, and then store it over at one of your beautiful storage spaces. That's the play.
That's the play.
Full circle.
That's it, man. That's it. And that's the other thing in that space. Like, people are going to pay their rent, right? Like, if you're paying $100 a month or $150 a month to park your facility or park your unit, like, okay, that's $100,000 rig plus.
That's true.
That you're not gonna.
Is nice.
Yeah, when we have a sheriff's sale, you're just not gonna. I mean, most people at least aren't gonna let that happen. So, unlike traditional storage where it's like, oh crap, I got some old raggedy furniture and boxes of moth-eaten clothes and a bed I don't even like because it squeaks. Like, I'll just leave it and let them sell it because it's only $1,000 and stuff. It's like, well, no, this is a $100,000 RV. We're not going to just let you, pawn this off because I didn't pay $150 a month to store it.
Now you're getting me excited thinking about the value of the collateral there versus the exponentially lower, annual cost. But
Right.
the psychology there and just the common sense of you're going to pay that bill every single month on time sounds like one of the more secure investments, I think.
Right.
So
I'm sorry, my camera's all foggy there. I don't know what it's doing. Yeah, you're absolutely right. I mean, it's the collateral, the cost of the collateral that makes it more likely to pay. And again, people do the dumbest things. I mean, the dumbest things. I saw people do stuff that would just blow your mind in the foreclosure business. We were buying foreclosures, it's just like, you didn't even take the time to put this on the market and just close out your position. Like, you could have sold it as is and picked up another 20 or 30 grand and walked away with that in your pocket. But instead, you just got hung up in your situation and panicked and did absolutely nothing. Did you ever call the bank? No, I don't think you did. Did you ever respond to the letters that they sent to you? No, I don't think you did. Like, you're an idiot. And so I think you're going to see that. I mean, you're bound to see it, even in the boat and RV storage space. So I'm not predicting there'll be no share of sales of those items. I'm just saying I bet it's going to be less.
Yeah, one would imagine.
That
seems like a solid prediction to lock in.
I like it.
So what have we missed?
Oh man, I don't know. I mean, you can take this anywhere you want. We've talked parking, we've talked multifamily, we've talked regular storage, we've talked self-storage, of course, boat and RV storage. RV parks is another fascinating one. I'm a passive investor in RV parks, and that's fun. That's fun to watch. That's not an asset class I understand, so I've not launched into being an active investor in that. I look at deals all the time, but it's a retooling, and they're trading. I don't know. They're trading at cap rates now that are, again, everything's getting compressed, but trade at 8, 10 caps, which is fine, but it's also a much more hands-on business. if you got overnight stays, if you've got, just people coming in for one night, in an RV park, things like that. It's just not somewhere I'm going, but it's an intriguing asset class to watch because, again, going back to the boat and RV storage, now people need to go have somewhere to stay when they go on vacation. And you can do, call it off grid using your RV. You've certainly done it plenty. You've got generators on board. You've got hot water heaters on board. You got everything on board for a little self-contained unit for a while. But if you're going somewhere and staying and want to actually like stay in and then go out and do things from a base camp, you're typically going to want an RV park. So those are fun things also to look at. I kind of look at it more as a free entertainment and go, what's this stuff trading for? That's curious. But that's probably just me being distracted, upon the actual goal at hand. But
no, definitely. Something that I realized when I was doing landscaping at one. So the one that I worked at was right on the ocean.
Right.
Had about 1,200 transient sites, 800 permanent sites.
It's huge.
And full water park. They had a full amphitheater. They did a show every Sunday that had been going on for decades. It's family owned, been in the same family for, I think at this point, 60 plus years.
Wow.
And you had a contingent of folks who would come in. Like there was this one particular group that would come in and fill out the campground in the winter. Food, everything. You didn't have to leave the place. It was a resort type environment. And throughout summer, really down in that neck of the woods, Myrtle Beach area, from Memorial Day to Labor Day, packed out,
right,
top to bottom.
Wow.
Right, like as a grown up as a local, you never went into Myrtle Beach proper during the summer. It was just not worth it. There was headache. I was in Myrtle's Inlet, just a little south, so you would stay there or go further south into like Polly's, where it was just not overrun by tourists. And tourists are the lifeblood of that economy.
Sure.
Right, like everything is built up around it. Whenever Labor Day hits, the place empties out. Now, more and more people have been moving down to that area, especially retirees from the Northeast. I can sell my place for, $850 or 1.2, and I can go down and buy something that's similar for half the price in the Myrtle Beach area and golf for the rest of my life. Plenty of golf down there. But just, being at one point, I've kind of worked in the front office a bit during one summer, and just seeing some of the numbers. If you do it right, you can have quite an attractive business going on and cash flow like crazy. And yeah, you have to have a maintenance crew on staff because sewage pipe busts. You can't just let that sit. You have water you're providing. You had trash truck that ran through, so a normal city trash truck that would go through the whole campground every single day, 7 days a week.
Wow.
So it is its own city,
right? Yeah.
And that is a kind of crazy example, but all that said, like you have it's quite a diverse asset class.
Right? Yeah, and I think one of the things that you pointed out there was that previously a lot of these campgrounds were seasonal. They'd empty out in Labor Day, but even more, what we're seeing is that they're going year round, which is another indication of, even in your mountain states, these campgrounds used to be, or these RV parks were, open like you said, Memorial to Labor Day. The people would come in, the people would leave, but a lot of them are going year round now, which just further increases the demand, not increase demand, but further is an example of the increase in demand.
Yeah, it's wild.
Yeah, very cool.
I think we're good, man.
Rock and roll, man. Well, hey, I've enjoyed it. Yeah, certainly. Thanks for having me on. Hope I was able to provide some value to you.
It was a good chat. We covered a bunch of topics. I love when I asked you the least favorite. I was like, I know what this is going to be because your pattern doesn't exist, right? It's such a diverse background of asset classes that you're just like, where am I going to make money? If I can make money here, I'm going to go there,
right?
And I'm going to go make money. And whenever there's something else that there's an opportunity cost to weigh, I'm going to go over there.
Right.
So I love it. So multifamily, do you have any other markets outside of the Southeast, or are you playing mostly in the Southeast?
It's mostly in the Southeast. It's yeah, I just don't have the bandwidth, and I don't want the bandwidth to go outside of that. There's plenty of opportunity. So staying there is I've looked at other markets, spent some time, working with some other operators this year, vetting their markets, traveling, looking at deals they're working on. And in the end, it just became, it was like, this is spreading myself too thin. This doesn't make sense. I don't know it that well. Stick to what you know. Stick to what you know, and if it's working, if it isn't broke, don't fix it. So.
Yeah, I think, the simple advice that's been around forever has been around forever for a reason. So anytime we get distracted and try to get a little too creative, high chance it's going to bite you in the tail. And the thing you think of is going to be simple. Like, I should have just stuck with what I knew.
Yep.
And here I am now.
That's exactly right. That's exactly right.
Hey, Sam, thank you so much for joining me, talking about everything from RV parks, self-storage, parking, multifamily real estate, everything under the sun. I love it. Thanks so much for joining me.
Thanks for having me on, Dalton. Do appreciate it.